All right, let's talk real estate. You see these massive funds, right? They're throwing around numbers like $1 billion portfolio. But what does that number really mean for you as an investor? Well, it's probably not what you think. Today, we're going to crack the code on the two numbers you actually need to care about when it comes to a portfolio's real worth. So yeah, this is the big question, isn't it? What is a real estate portfolio really worth? I mean, you see that huge price tag, that flashy headline number. Is that the figure that's actually going to impact your wallet? The short answer, no. That big number is just the cover of the book, not the story inside. And that brings us to the two key players in this whole game: gross asset value, or GAV, and net asset value, NAV. Think of it this way. GAV is that big, shiny sticker price on a car. It's the headline number. But NAV is what you actually own. It's the real value, the equity that's yours after you subtract all the loans and debts. Okay, so let's get into it. We're defining the core terms. And don't worry, the math behind the money is actually pretty simple. And once you get it, you'll look at these portfolios in a whole new way. So first up, GAV. Gross asset value. Honestly, this one's super straightforward. You literally just add up the market value of everything the fund owns. Every building, every mall, every single asset. It's the grand total, but, and this is the key part, it's before you take out a single dollar for any mortgages or loans. It's the top line, everything's perfect number. And now for the one that really, truly matters for your pocket. Net asset value, NAV. The formula is simple. You take that big GAV number we just talked about, and you start subtracting. You pull out all the mortgage debt, all the other liabilities, basically everything the fund owes. Whatever is left over, that's the NAV. That's the real equity. That's what belongs to you, the investor. Let's put some real numbers to this to make it crystal clear. Okay, imagine we've got an office building and a retail center. Add them up, and their total value is $80 million. That's our gross asset value, our GAV. Nice big number. But hold on, we've got debt. There's a $45 million mortgage and another $3 million in other stuff we owe. So we subtract that $48 million in liabilities, and what are we left with? $32 million. That's the net asset value. See the difference? Huge. All right, section 2, the leverage multiplier. This is where things get really interesting. We're talking about how tiny changes can end up making some massive waves. This probably has you wondering, right? If NAV is the number that actually matters to my wallet, why does everyone keep shouting about GAV? Why is that the number you always see in the headlines? Well, to be fair, GAV isn't useless. It does give you a sense of the sheer size and scale of an operation. It's a quick way to compare different funds or see how diversified their holdings are. And let's be real, it's a fantastic marketing tool. I mean, billion-dollar portfolio just sounds incredible, doesn't it? But for you, as an investor, you've got to remember, it's only the starting point of the conversation. Because the real magic, or the real danger, that connects GAV and NAV comes down to one single powerful word: leverage. Check this out. This is how leverage can turbocharge your returns. Let's say you've got a $100 million property. You used $60 million in debt to buy it, so your equity, your NAV, is $40 million. Simple enough. Now let's say the market does well and the property's value, the GAV, goes up by just 10%. So it's now worth $110 million. Here's the kicker. Your debt doesn't change. You still only owe that original $60 million. So what's your new equity? It's $50 million. Think about that. The asset went up 10%, but your equity jumped from 40 to 50 million. That's a 25% gain for you. That right there is the power of leverage. And it's exactly why smart investors are absolutely obsessed with NAV, not GAV. Because a small bump in the total asset value can create a huge, amplified return on the actual money they put in. Okay, so now for part 3. We're going beyond the basic formula and looking at the real-world complications. Because, it's never quite that simple. Yeah, in the real world, figuring out the true NAV isn't always so cut and dry. That GAV minus liabilities formula, it's the foundation for sure, but a smart investor knows you have to dig deeper. The timing, the fine print, that stuff can change the entire picture. One of the biggest culprits here is something called valuation lag. See, unlike the stock market where prices update every second, real estate gets valued much less often, maybe quarterly, maybe even just once a year. So picture this. The market starts to tank in, say, April, but the last appraisal was back in January when things were great. The fund's official NAV might still look fantastic all the way through the summer, totally disconnected from reality. Then, bam, a new appraisal hits in the fall, and the NAV suddenly craters. It's a nasty surprise waiting to happen. And another thing you've got to watch out for is how the NAV is actually split up. It's not always a simple case of, here's your share. Often there's what's called a waterfall structure. This means the fund managers, the general partners, get a special performance bonus. It's often called promote or carried interest. Basically, it's a slice of the profits they take for themselves after you've hit a certain return. And that slice, it comes right out of the total NAV, which means less for you in the end. And finally, you really have to think of the stated NAV as just the tip of the iceberg. What's hiding under the water? A whole bunch of what you could call hidden liabilities. Things like future repair costs, money they have to keep in reserve for when a tenant needs a new office layout, legal fees, property tax fights. All these little things are future costs that are going to eat into that NAV over time. A true NAV has to account for all of it. Okay, so with all that in mind, let's build your investor toolkit. We're going to cover the big red flags you absolutely need to watch out for.
So here's your checklist. Number 1, if you see the GAV going up, but the NAV is staying flat or even worse, going down, that's a huge red flag. It probably means they're piling on debt. Number 2, watch for a big difference between what a property is appraised for and what it actually sells for. That means the appraisals are inflated. And last, if they report an NAV but they're not totally transparent about all their liabilities, you need to see the whole picture.
At the end of the day, it really all boils down to this one idea. GAV is great for getting a sense of the scale, the bigness of it all, but NAV is what determines what's actually in it for you. It's the number that drives your returns. It's the number that tells you what your piece of the pie is really worth. So, next time you see one of those flashy headlines about some massive multi-billion-dollar portfolio, you'll be armed with the right knowledge. You'll know that the first question to ask isn't, wow, how big is it? The first question you're going to ask is, yeah, but what's the NAV?